Most people trying to buy their first home in the UK think the only factor that really impacts their affordability when getting a mortgage is their income. But what if I told you there are potentially 5 other factors that can potentially impact what you can borrow with a mortgage lender in the UK? And so many buyers get at least 2 of these factors completely wrong. My name's Joe and I'm a mortgage advisor in the UK, and I help people like you all the time secure the property of their dreams for not only today, but for the rest of their lives. Whether this property is for the next 5 years, 10 years, or 15 years, this video is the perfect way to plan short-term, medium-term, and long-term. I'm going to give you all the tools to hopefully save you some real time and money. So in this video, we're going to be building out this document right here that's basically going to be a one-stop guide on how much you can borrow in the UK. It's going to really allow you to plan and hopefully save you some time and money when you eventually enter the market. And I promise you, by the end of that video, that document is going to be completely full of information that you're going to be able to use to your advantage. Now, the first box we absolutely have to build out is salary multiples. Now, it's the one you're going to most expect, so it's the one we have to cover first. Now, I'm going to be honest with you, there has been a few changes recently, and there's been a lot going on, at least in the last couple of years, in terms of affordability and what lenders are willing to give you based on your income. And again, this is just about how much you're earning on a yearly basis before tax, which is really important to understand. Now, for you people that are self-employed, it's going to be quite easy to understand. Most of the time, it's actually easy to take a 2-year average of your income. So if you have a look at your last 2 years tax documents, you're going to be able to see a little breakdown of what your income is, add up both years, divide it by 2, and there is what your income is for a lender in most scenarios. And again, if we need to look at it a slightly different way, we certainly can, and there's going to be different videos that we'll make about that. And for you people that are earning PAYE, so you're fully employed and you get pay slips every week, bi-weekly, every month, 4-weekly, whatever structure they do, all you need to do is annualize that income that you see on your pay slip without going into bonuses, commissions, and other bits like that. Just take your guaranteed income, so the income that you know you're going to get every single month, and annualize that figure prior to tax. So don't take the net income figure, take the gross amount. So what we're actually going to do is we're going to build out an example here. So apologies, it's a little bit messy with the boxes, but an example of this is going to be, let's say you're earning £50,000 in the UK, and we're going to times that by 4.49, and that equals a potential borrowing £224,500. We'll make that in a nice yellow color so you can see it. There we go. So we have our example in there now. So if you've got a £50,000 income household, then with standard typical cap borrowing, you're going to be able to get yourself £224,500 as the mortgage amount. Deposit would obviously go on top of that as well. Now, where things have changed is lenders are now allowing 5 to 6 times for strong applicants. Now, it's worth noting that, and again, we're going to make this look a little bit nicer now as well. So now we can actually see that we have the ability to loan 5 to up to 6 times income in certain scenarios. Now, when we enter the realms of 5 to 6 times income, it kind of comes back to the client a little bit on, are you able to afford this monthly payment? Now, for a lot of people, 5 to 6 times their income is more than enough and more than what they need when it comes to looking at houses in your local area or looking at houses in the area you're looking for. Now, personally, I don't think I would be comfortable giving myself 6 times my household income, but again, it's not just about me, it's about what your personal threshold is. Now, I like to live my life a little bit. I like to go out to restaurants. I like to, not look at how much I'm spending on a weekly sort of shopping bill and things like that. So again, I live my life a little bit differently. Some people come to me and they're absolutely comfortable with 6 times lending. And again, I look through bank statements and I understand that they're perfectly comfortable sort of cooperating and handling 6 times their income. It's not for everyone. Now again, because this guide is mainly targeted for first-time buyers, it's really worth highlighting right now that for first-time buyers, there are a number of lenders more than comfortable giving 5.5, 6 times income because you're a first-time buyer. Now, it is really important to note that when looking at 5.5 to 6 times income, we are sort of shortening down the search for what lenders we can actually go to. But a lot of these lenders are on the sort of top 10, top 15 in terms of cheapest lenders available. So again, you're not going to be massively missing out on potential interest rates by going to a lender where you need 5.5 times or 6 times your income. So it's really important to understand that you're not putting yourself in a really adverse position by stretching yourself to 5.5 to 6 times. Again, we're still talking high street, big names, Nationwide being one of the biggest ones out there. Again, if we're looking at 6 times income, for example, we take that £50,000 household income right there in the example, and instead of £224,500 potential lending, we're now looking at £300,000 potentially being lended to you, the client. So again, it's really worth understanding and knowing that you can really stretch your affordability, and in some scenarios, so much so that you might actually say, hold on a sec, I don't actually want to borrow that much, which is an overwhelming feedback that I've been getting more and more and more over the last weeks and months, where people just aren't willing to stretch to that 6 times, which is absolutely perfect, because again, you should be the one that decides your budget, not me. So we're now going to be looking at the next stage, which is income, debt, and credit score. Now, I appreciate we've already briefly touched over income, but when we're actually looking at income, it does get a little bit more complex when it comes to bonuses, commissions, and other things that just potentially aren't guaranteed, but they are there, and potentially overtime as well. So many different things to consider. Now, debt and expenses kind of fall under one bracket here. So you've got committed expenditure and also other expenditure that you just have on a monthly basis, where you are going shopping, you've got a really expensive gym membership, all these other things that aren't actually debt as such, but again, they are as part of your life. You can't get rid of them, or at least you can get rid of them, but you maybe don't want to get rid of them. So again, it's worth throwing that in there and discussing that in the video. And then a really, really big one that people kind of brush over a little bit is credit score. Now, credit score is really important when getting a mortgage, but to a certain extent. And again, we're going to go over that in a little bit more detail right now, because I think it's super, super important to understand where it comes in, why it's important, where it's not important as much. But again, kind of discussing it in an open and honest way as a mortgage advisor in the UK. So again, it's really important to cover that. Now, the first 3 things I want to cover all fall under the income bracket. So bonuses, commission, and overtime. Now, again, I appreciate a lot of this is for PAYE clients. And again, I know there are certain other things that come into play with self-employed individuals, like dividends, also how your basic income is structured, and then potentially share of net profits. And again, it's all really valid, but it kind of falls under one bracket when you listen to what I have to say about bonuses, commission, and overtime. Now, one thing I want to say really, really quickly about all of this is, do you need it? Do you need the additional money to support how much you need to borrow? Now, if we look at the first slide where it's 5 to potentially 6 times your income as a first-time buyer using your guaranteed income. So like I said, if we were looking at 3 months worth of pay slips, then, is this income guaranteed? Then if it's a yes, we can annualize that number and we can be happy with it. If that is 5.5 to 6 times that amount, and that's a comfortable borrowing amount, then no, you don't need your bonus, commission, or overtime income to boost affordability, because you're already there. Likewise, for self-employed individuals, we've taken your last 2 years worth of tax documents, averaged it out, and times that by 5.5 to 6 times your income. Then all of a sudden we ask the same question: is there enough money there to potentially borrow what I need to borrow? And again, if the answer is yes, don't worry about net profits. As long as your company is looking in a really, really healthy way, then again, you don't have to worry about that. All a lender's going to be really looking at, if you're a self-employed individual where you are the company director, for example, is they're going to have a look at the company accounts and make sure that actually the company's not at a really bad loss, or a loss at all really in some scenarios, because they want to make sure that your income is sustainable. Again, they're not going to do those checks on an employed individual, but again, they want to make sure the company's reputable, they exist, they're going to be able to continue paying you, what type of contract you're on. So it's drifts and troughs. Regardless of what scenario you're in, they're going to be looking at that income and basically assessing whether or not it is sustainable. Now, for those people that are looking at this thinking, I actually do need my bonus, I do need my commission, I do need my overtime to boost affordability, because actually for some people that does make up a really, really significant amount of their income, which is completely valid. I myself am one of those individuals where I really needed my commission when I bought my first home. So again, it's important to understand where you stand with that income. Now, I think it's really, really important to highlight here that there's not a one-size-fits-all scenario. So if I talk to someone that gets annualized bonuses and they have done for the last 5-6 years, fantastic. Again, we know the approach there. There's certain lenders that really love that, love the consistency. They'll take an advantageous 2-year average. And there are other lenders that will potentially take 3-year averages. And there are other lenders that will potentially look at it slightly differently. So again, when we look at bonuses, there's not a one-size-fits-all, but we look at the individual's circumstances. How was the bonus paid? Is it monthly? Is it annually? Is it biannually? Is it sort of predictable? Has it increased in the last year? Has it decreased in the last year? So all these different varying factors will depend on how a lender will look at it. But again, you can slightly, take a bit of lenience with it and say, right, well, I know that this lender really likes it when the bonus has increased or when the bonus has remained the same. And this lender takes a 2-year average, no questions asked. So again, depending on the setup, depends on what lender you go to, and depends on the outcome of that. But there are a number of options out there where if it's bonus bonuses, commission, or overtime, they can take up to 100% of all of those incomes and add it onto your 5.5, 6 times your income, provided that it's sustainable. If they see that one year, let's say a year ago, you had a bonus that was £26,000 and this year it's £2,000, some lenders may go, we're not too sure about that because, again, it's such a massive jump. Why did it come down so much? Are you even going to get a bonus next year? So again, this is why we go through the stage, which is underwriting, which is to discuss and look at these different scenarios. But the advantageous part of speaking to a mortgage advisor is that we can actually call lenders. We've got relationships with bank managers where we can basically say, right, well, this is the scenario the client has. I've got the pay slips, I've got the bank statements evidencing the bonus, the commission, the overtime. This is what's going on. What's your viewpoint on it? What is Halifax's view? What's Nationwide's view? And again, we can get an understanding before even submitting an application for you. But the be all and end all is if you need the money, we can use the money. Now, the next one is really, really important. So we're going to be looking at debts and expenses. There we go. So debts and expenses are absolutely massive. And there's a reason why we split it into two, in my personal opinion. Now, for me, debts are crystal clear. You know, we've got a credit card, we've got a balance, we've got a loan with monthly mortgage payments and a balance. And we can kind of look at them and split them into different areas. But essentially with debts, we have a few different options. Now, you have the ability to carry that debt into your mortgage. So you can basically tell a mortgage lender, yes, I will continue paying that loan. That is going to be there after I am the homeowner of this property. And that's fine. It will affect affordability because, again, if you're committing £200, £300, £400 towards, let's say, a car finance, for example, the lender's going to say, well, that's £200, £300, £400 that you're not committing towards the mortgage, or you can't commit towards the mortgage because it's committed debt. So again, that will potentially impact affordability. And when it comes to different lenders and different affordability stress tests, it's basically going to get knocked off your 5.5, 6 times income, that multiple. Or if you're going for a sort of different lender where it's 4.49 times your income, again, it's going to potentially get knocked off there. I can't give you an exact figure. And again, we can look at that in different videos and potentially look at different actual calculations. So look at how maybe a lender like Halifax might treat a £300 car finance versus a lender like Nationwide, for example, and actually see what impact it has on affordability. I wanted to stop the video just for one moment to quickly tell you how we can help you on your home buying journey. Whether it's your first home, second home, moving home, buy-to-lets, whatever it is, we are here to help. Now, I'm a mortgage advisor in the UK, and of course, I've got all the tools equipped to help you with whatever mortgage needs you are looking for assistance with. All you have to do is click that top link in the description that is access to my online calendar. Book in a call. We can go through all of your questions together and make sure you're best prepared for whatever mortgage you're looking to do, whether it is an existing mortgage or a brand new one. We're here to support where we can and make sure not only is it right for you today, but right for you in the future as well. Click that link, book in your call, and we can have a conversation. Credit cards are one of those where a lot of people use credit cards and clear them every single month, or clear them every couple of months, or make the minimum payment and with the full intention of clearing it a few months, I don't know, let's say after Christmas, for example. I don't know, people use it in the correct way. That's how you're supposed to use credit cards. As long as you make the minimum payment, that is how it is intended to be used. And again, what we can do on a mortgage application to mitigate any potential affordability costs with a credit card, for example, is say to the lender, this is going to be repaid prior to completion. So a lot of different lenders, a couple of different approaches there actually. Some lenders will say, right, well, can you clear it now before we issue the full mortgage offer? Because we want to make sure that that's settled. And then other lenders will go with the approach of, okay, that's absolutely fine. So we're going to put a condition on the offer saying that these debts need to be cleared and evidence that they're clear prior to us completing and giving you the money to buy this property. And again, if you are to say, I'm going to clear that before completion, you do have to clear it before completion, but it is also going to positively impact affordability because it's not going to negatively impact affordability. Now, expenses is a really big one. And again, it does kind of fall into two categories here. So you've got committed, whereby you have to make these certain payments. So a good example would be maintenance payments. So again, where you have separated from a partner and you have to continue paying towards, let's say, childcare, for example. Much like if you were to have a child and actually have to pay childcare, that is a committed expenditure. You can't just stop paying childcare until for most people, your child goes to school. So for those of you that have children between, a baby's age, so anywhere from sort of 6 months, and I appreciate sometimes it's a little bit before then, all the way until the age of 4, potentially up to the age of 5, depending on when your child's born, you're going to have fairly sizable childcare costs unless one of you aren't working. So again, that is committed expenditure and it will have an impact on affordability. Again, there's not a one size fits all for this scenario. Some lenders will have less affordability impact than others. And again, it's worth highlighting this to your mortgage advisor so they can go off and work out affordability and who the potential best lender is, because again, that's going to have an impact on affordability. Now, the other side of expenses is the discretionary expenses. So these are things that technically you can cancel, but you don't have to cancel. So the biggest one for me is really expensive gym memberships, or you go out and eat a lot of food in really nice places, and again, you spend a lot of money on a monthly basis on very nice things that you don't necessarily have to spend your money on. Now, again, for a lot of lenders, if you can stop doing that, then you're absolutely fine. If you have the ability to stop doing that, then you're absolutely fine. Again, this is non-committed expenditure, so it's discretionary. So if you have the ability to stop doing that thing, then the lender's not going to negatively impact your potential borrowing amount because they know you can go off and cancel that. And if times do get tough and things do get a little bit tighter with affordability, as in you've moved into the property, they know that you're going to actually put the mortgage first because it's debt, rather than, let's say, a really nice gym membership. They know that these things can be cancelled and can be stopped. Now, the next really important one is credit history and score. You'll have to excuse my terrible typing. You wouldn't be able to guess that I'm on a computer all day. Now, credit history and score is probably the biggest factor that is overlooked by so many clients, and it's kind of dangerous in a lot of different ways because clients fail to understand the credit scoring system, or at least the credit scoring system fails to enable people to understand it because it's so complex to understand. Even myself, who have worked in the mortgage industry now for well over 4 years, I don't understand how they make some of these scores up, but I do understand what affects the score. So score is incredibly important when we look at loan to values, and we're going to bring that on the screen in just one moment. And credit history is also extremely important to understand in terms of black and white, really. So criteria for lenders do dictate what you can and cannot have on your credit history. Now, CCJs, so if you have had a parking fine and you've just completely ignored it and they've issued a county court judgment, we could be in a little bit of trouble there. Again, if there's any active county court judgments, it's going to have an impact on who we can go to, because lenders will black and white say absolutely no. If you've got an existing outstanding county court judgment, we won't look at you. There are some lenders that potentially do it depending on the monetary amount of the CCJ or CCJs. So if you've had multiple parking tickets build up, I know some people that are builders and other people that have to travel a lot for work, it can be very easy to get parking tickets in your personal name. Again, looking at credit history, defaults, so active defaults with credit providers, utility providers, anything that will really show on a report is going to have really bad effects on your credit score, but also credit history, because again, it's black and white for some providers. If you've got an active default or an active default over a certain monetary amount, it's going to cause you some problems. And then again, if we look at the scenario again for arrears, so missed or late payments on utilities, on debts, again, this is going to have an adverse effect on potential affordability, but also what options you have in terms of lenders. Because again, if you're in active arrears, some lenders will just not look at you. Some lenders will just not look at you at all. Or if you've had previous arrears or previous late payments, again, it depends on how long ago they were, what they were for. Was this an isolated event, or do you have loads of late payments across your whole credit file? And again, all these different things add into your credit history. And it's kind of like a little bit of a story for a mortgage provider with how you are with credit. So it's really important you kind of look after your file, look after how you sort of understand and work with debts or utilities. And even if it's a partner and you're named on it, it's a joint responsibility. If it's on your credit file, it is part of your responsibility. So it's super, super important to understand looking after your credit history is going to be one of the most important things you can possibly do for your mortgage. And again, that is going to feed back into your credit scoring, which is really, really important to understand when we look at loan to values, which we'll have a look at right now. So now we have a little bit of information here on loan to values. So I tried to make this look as nice as I humanly can. Again, I'm not the most creative of people, but hopefully hopefully this is nice and clear. So a 5% deposit is 95% loan to value, 10% is 90% loan to value, and 20% is 80% loan to value. Now, what is this? More importantly, how does it link to how much you can borrow, and why is it linked to credit score? Now, as you can clearly see, deposit is directly linked to loan to value. Now, essentially, the bank doesn't care about what your deposit is to a certain degree. What they actually care is what is the loan to value. So how much risk is it to the bank? So the lower the deposit, the higher the risk is for the bank, because if you default on the mortgage, they have a lot less equity to play around with and a lot less equity to cover themselves, essentially. If you're unable to pay for the mortgage, then they're going to sell that property potentially in a repossession to essentially get them their money back. Therefore, the less equity you have in the property, the more risky it is for the bank to give you that mortgage loan, because it gives them less of a chance that they're going to be able to get all their money back when selling the property. Now, there's still very likely that with your 5% equity, if you defaulted straight away, that they'd be able to sell the property, get their money back quite quickly. However, because of the increased risk that they wouldn't be able to do that, because let's say they had to auction the property, for example, to get their money back, potentially it goes for less than you bought it for. Therefore, there is a risk there. So what does that actually mean, and why does credit score come into the play here? Is the fact that if it's riskier for the bank, they want to mitigate that risk very slightly by ensuring that your credit score and credit history is very, very clean. Now, that essentially means that those people that are looking to get a 95% mortgage, therefore a 5% deposit, need to have good credit history and a good credit score, because again, that mitigates the risk very slightly for the bank, that they've basically done their due diligence and said, right, well, applicant 1, applicant 2 both have good credit history. Yes, it's very risky for us to do a 5% deposit mortgage deal, but we're happy with it because they have always kept up on all their previous debts and their credit history looks very clean. So yeah, high credit score is basically how you get access to a 5% deposit. It has been a little bit more of an increasing problem where people are coming to us, let's say a first-time buyer with no credit history whatsoever. You basically don't exist to a bank, and we do an application and it says no, their credit history is not up to the right standard. So I'd always encourage really great use of credit, because that's going to boost your score, potentially giving you access to lower deposit deals, which could be the difference between you getting on the ladder now or in 2 years, for example. And something I do want to highlight here is that bigger deposits improves rates. Now, this is a bit of a bold statement, but again, it does stand true, especially when you look at the sort of higher ends of the market. And to be honest with you, throughout the whole market, the bigger the deposit, the lower your interest rates. So again, it stands very well when you compare what deals you have available to you on a 5% deposit versus what you have available to you on a 10% deposit versus what you have to you on a 15% deposit. And it continues. Now, I can hear the next question coming up, which is how long does that continue for? You know, as I increase equity in my property, how many different thresholds are there for mortgage lenders to potentially bring down my interest rate? Now, again, unfortunately, there's not a one size fits all. Every lender's criteria and every lender's products do slightly change between each of them, which is why I have a job, because again, I have to find you the best option. But if I was to look at Halifax, who are the biggest residential mortgage provider in the United Kingdom, we can see their loan to value range. So a 5% deposit is going to get you one set of deals, 10% a different set, 15%, 20%, 25%, and 40%. So those are the different thresholds. So we've got 1, 2, 3, 4, 5, 6 different thresholds. And as you work your way essentially down the loan to value brackets, but in your scenario up the deposit brackets, you are granting yourself access to better deals as and when you look at them. And again, a great way of doing that is actually when you speak to your mortgage advisor, is have a look at the different loan to value brackets and how that can potentially affect not only your interest rate, but your monthly mortgage payments. Because again, you've got to remember, if there is a set purchase price that's going to get you the property you need, the higher the deposit you go for, the less you're borrowing, which means the less money you have to pay on an interest basis every single month. And for those of you looking at potentially stretching your affordability, buying somewhere even nicer, remember there is a theoretical maximum that you can borrow. And again, you can look at that with a mortgage advisor, go through your own personal scenario, what your expenses are, what your debts are, what your income is. And again, we can tell you how much you can borrow. In that scenario, the higher amount of deposit you can commit to it means actually the higher amount you can purchase a property for. Now, the next thing I really want to focus on is monthly affordability. Now, this is a little bit less on the lender's assessment and more actually on what you should be doing in assessing your own expenditure and how much you can potentially afford to borrow. Because again, we've previously discussed that people that are going up to 6 times lending are oftentimes saying, actually, I think that's too much. So the first thing I'm going to put is check lifestyle costs. Now, for me, this is a really, really important one because, again, we kind of looked over and brushed over it, if you will, the committed and non-committed expenditure and how that can affect how much you can borrow. And again, it is discretionary. But again, like I mentioned about my own personal scenario, and again, I have this conversation with so many clients all the time, which is, are you comfortable with cancelling these different things? Do you want to get rid of your expensive gym membership? Do you want to stop spending loads of money on your weekly shop by buying really nice foods? Do you want to stop those things? And the answer most people say is no, I don't want to stop. I want to live my normal lifestyle while also having a house. And the good news is for a lot of people now that because buying a property is way more affordable if you have the deposit than renting, that actually you don't really have to make sacrifices, because most often time, if you are already renting a property that is the right size in the right area, actually, if you're young enough and you can get a mortgage with a reasonable mortgage term, these payments should be within your budget anyway. Now, something a lot of people don't consider, and it's something that's really, really important, and actually lenders consider it, is rate rises. And again, we'll move that over so it looks nice with the document. So yeah, rate rises are something that's incredibly, incredibly important. And it is something that should be considered when you're actually property. Because again, where we are today might not actually be the situation the country is in, and interest rates are in 2 years or 5 years, depending on what fixed deal you go for. And that kind of leads me on to the next point here. The point is fixed rate mortgages. And again, we'll make this over so it looks nice with the document. So fixed rate mortgages, why is it important and how does it link quite nicely rate rises? Now, the hardest point you're going to own your home and the most expensive your home is ever going to cost you is likely to be in the first 2 to 5 years of owning it, because you've got the least equity that you're ever going to have in the property, unless there's some crazy property crash that we just haven't seen since 2008, and before then never really at that volume anyway. It's going to be the most expensive in the first 2 to 5 years. You're going to build up equity in the property. You're going to be able to build up that equity quite quickly with not only your repayments but potential property price increases with inflation. And as you build up that equity, the deal you then later secure on a fixed rate mortgage should be at a lower interest rate compared to what is available at that time. Compared to what it was previously, we don't know, because the market can move whatever way it chooses to move, and predicting anything in 5 years' time is just impossible because we don't know where we could be in 5 years as much as we think. So how does rate rises and fixed rate mortgages link together? Well, the longer you fix your rates, the less prone you are to rate rises, because again, your fixed interest rate cannot change in the period you are fixed in for. So if you are operating at the absolute top of your affordability and you have no flexibility in what budget is available, fixing for 5 years is almost certain to give you a little bit more flexibility when the 5 years is up. Granted, you are in a very stable scenario for 5 years. You're going to have pay rises, hopeful promotions, and your situation should improve across a period of 5 years, hopefully. And again, you're going to be putting yourself in a better position than you are at the start of the mortgage. It's different, and you are less prone or less risk to rate rises, and you wouldn't mind risking that. Then you can go for a shorter term fixed deal. It is right for some people to go for shorter term fixed deals because again, in that scenario, people often prefer flexibility, but you can, in a lot of scenarios, in most scenarios, choose to go for the stable option if you have to. And again, if you need stability, a 5-year fixed option is stable, and you're not going to be paying much of a premium to secure that 5-year rate. And it's very valuable for a lot of people because you know that your interest rate is going to stay the same for 5 whole years. That means 5 whole years of paying down the mortgage, building equity, and hopefully accessing a better deal in 5 years' time. And that, of course, leaves us with this bottom statement here: higher borrowing equals higher payments. So again, we can look at your lifestyle, we can look at what you're spending, we can look at what your budget is on a monthly basis, and truth be told, that should be based on your household net income. Yes, the bank uses your gross income, but when you're calculating your own budget and how much you can borrow, because again, it's not just about the lender in this scenario, take both of your incomes, combine the net income, and then take away your monthly expenditure that's not going to stop once you move home. So yeah, I'm talking about food, phone bills, gym membership, potential debts, other committed expenditure, childcare costs, all these different things that you know are going to continue for at least the first 2 or 5 years of your mortgage, whatever fixed deal you end up going for. Take that off your combined net income. You're left with a basic budget, and you've got to remember you need to account for utilities, council tax, and of course your mortgage payment, which are always going to be taken out. And on top of that, obviously you've got your home insurance if you're buying a flat, where that is covered in the lease charge. So again, once you take those costs off, And I can include a link in the description as well, where you can basically go and calculate what your likely costs are in the UK for utilities, council tax, things. What I'm going to do at the end of the video is I'm going to put a little graphic on the screen that shows you potentially what your cost is going to be monthly for council tax, and the other bits we mentioned, home insurance, utilities, based on the average UK. So at least then you can use that to plan. Although I know that my household cost is slightly above the average in the UK, but you could fall slightly above, slightly below, or bang on. But it's worth knowing, and again, we will cover it later in the video. So now, what can we do to improve your borrowing? Because again, it's going to be really, really important to understand how you look at all of these different metrics here. How can you improve it? And there's a couple of really simple points that I really want to cover. Now, the first point is something that we already briefly discussed, which is to raise your deposit. Now, yes, this isn't going to potentially raise just your borrowing amount, but what is actually going to be focused on is raising the buyer property for, which is actually what matters. Because what you're actually doing here is you're enabling yourself to go off and buy a property that's either a higher purchase price, therefore you can see yourself in the property for longer, because no doubt it's either bigger, better quality, or in a better area. Again, that's the price you pay. So again, raising your deposit enables you to do that in a number of different ways, of course, and then potentially if you stick with your purchase price and you are very, very sure on what you want to buy and where you want to move and what the price is going to be for that, then increasing your deposit is just going to bring that interest rate a little bit lower down, provided you meet a lower loan to value bracket, which we previously discussed. Now, the next one here is pay off debts. Now, I'm going to be honest with you, this is really easy for me to say, and it's not necessarily something in practice, because again, we all live our own lives and we all have our own expenses, and we all have our own commitment, and paying off debt can be one of the hardest things someone has to go through. So me just blindly saying pay off your debts is such an easy statement for me to say, and it's by no means me saying this is an easy step to complete, but the truth still lies. So you paying off your debt means that you have less monthly expenditure committed towards going to debt payments. Now, a big one that I see is if there's a low loan balance where there's high interest rates, or even if there's no interest rates applicable on there, because I've seen some zero interest savings and zero interest loans where people are just paying it off over a short period of time. And in some scenarios, we're talking about low balances where there are high loan payments, so high monthly payments. So if someone is paying down an £800 loan and they're doing it in £100 a month increments, obviously there's only 8 months left, but most of the time you're completing in 3, 4, maybe 5 months of that process. So a lender is potentially decreasing your borrowing power because you haven't paid off an £800 loan because you're paying it in £100 increments. Now, I appreciate £800 can be a lot of money, but if it's potentially going to impact where you can live for the next 5, 10, 15, 20 years, it's well worth doing before starting the journey. And honestly, it's going to improve everything, because whenever we can say to a lender, this is going to be repaid prior to completion, or let's say you come to us and it's fully paid anyway, then again, that's not going to have any negative impacts on your affordability, potentially improving your borrowing without you even realizing, because you've done it prior to application. So again, it's really, really important, and I know it's not an easy thing to do, but just prioritize those things where the monthly payments are super, super high, because they're going to be the things that are bringing down your affordability the most. So we've got the next one here, which is increase mortgage term. Now, I'm going to be completely honest with you, I don't absolutely love this. Increasing your mortgage term is a positive, but it can also be a negative. Let me explain. So obviously the way your mortgage works is you've got the fixed period, so how long your deal is locked in for, so the interest rate, how long that stays the same. And then you've got the mortgage term itself. So that is essentially how long you pay the mortgage off for. Some people pay it off in 40 years, some people pay it off in 35, some do it in 30, and some do it really random years because they might manage to make overpayments or reduce their term as and when they can. Now, increasing your term does actually reduce your monthly mortgage payments, and the rationale behind it is because you're actually decreasing the amount you pay on your mortgage on the repayment side of things. Now, your interest is going to stay exactly the same, because regardless of the situation, if your interest rate is, I don't know, 5%, for example, and you've got a £200,000 mortgage, you are still going to have to pay the interest on the £200,000 mortgage in the exact same increments. And again, this does get a little bit complicated because month on month, you will pay slightly more interest, but the main thing about it is that you're paying that interest over more years. Now, that doesn't decrease the amount because your interest is charged on a daily rate, and that's going to be carried forward throughout the term of your mortgage. And without making it complicated, your mortgage is in 2 chunks. You've got the amount you're repaying to reduce the loan and the amount that is there for the interest. Now, if you increase the term, you're essentially making the interest the exact same. That does not change. You cannot change that, but you're basically reducing the amount that you are repaying towards the capital, therefore bringing your payments down in a way that has its advantages and disadvantages. Let's just say that. Now, I feel like I'm being really, really negative towards this. And does it warrant me being negative towards it? Yes and no. I like clients going into this and reducing their term as much as possible because, let's be honest, I want you to have that debt for as little time as humanly possible, because the sooner you are mortgage free, the sooner you are free to potentially retire, live your life a little bit more, because a mortgage is expensive. And you have to pay it every single month for as long as that mortgage term exists. So ideally, that does go away faster. However, I'm going to put my positive cap on just for one moment to explain why I've put it in this section at all, because it sounds like I don't want you to do it, but it is right for some people. Now, increasing your mortgage term, let's say from 30 years to 40 years, that can potentially help you improve your borrowing, not from the 5.5, 6 times borrowing that a mortgage provider is willing to do. That stays the same, and obviously they take into account any debts and committed expenditure you have. But where it does come in and it does help improve your borrowing is your own restrictions. Now, if your mortgage is £100, £200 less because you've extended the term, that potentially means you could increase your borrowing amount up to the 5.5, 6 times that some people aren't comfortable doing, because you're spreading that over a longer period of time, meaning that your repayments are lower, but you can potentially increase the borrowing amount, which will increase the interest a little bit. So the interest is higher, the repayments are lower, but you can potentially afford to borrow more money because you are reducing that bulk of the money that you're repaying straight away. And again, it does compound over time. So as your mortgage term reduces, the higher the repayments are, the lower the interest gets over time. So it's really, really important to know increasing your mortgage term can improve your own personal threshold and your own personal budget. Because let's say you want to commit £1,500 towards the mortgage every single month, you going for a 40-year mortgage term instead of a 30-year mortgage term can potentially increase that borrowing amount quite considerably. Now, the final one here, which I really like, obviously, is use a mortgage advisor. Now, this is really, really important because, again, if you want to access these 5.5, 6 times lenders where they are willing to give you this top end, and you want to discuss the mortgage term, the fixed rate, all these different things that we've kind of covered in this video briefly, but not to a personalized extent for yourself, then going to a mortgage advisor is the best way of doing it, because you can say, right, well, this is my budget. I can potentially stretch to this. This is how much I get paid. These are my committed expenditures. These are my debts. And this is how old I am. And this is what deposit I've got available. You can tell me, you can tell us all these different things about your scenario and say, right, I want to get property ideally at this price. Or you can say, right, what type of property can I get at what price? So again, these are conversations that you can have with a mortgage advisor, personalized to you. So it's incredibly important. My job is not to find you the cheapest deal available, contrary to belief. My job is to get you the right mortgage deal for you. Because again, just because it's the cheapest doesn't mean it's right. So many advisors try to go for the cheapest deal, which isn't what we've been trained to do. My job is to make sure it's the right deal for you. Go through your situation. Every deal should be personalized for the person that's taking the mortgage. And so oftentimes people say, well, I've had a cheaper quote somewhere else because, the payments are this. And then I turn around and say, yeah, it's cheaper because instead of paying it off in 35 years, you're adding 5 years to the mortgage term. Do you want to pay it across an extra 5 years, or would you rather, because you can afford it and because I've made that assessment, you pay it off 5 years sooner? And again, a lot of people say, you know what, you're actually right. So again, good advice is to clear that mortgage as fast as possible, and the best advice is to find the right deal for you for the long term, not just for today, tomorrow, or this year, for the long term and for your family's future. Now, the next area I'm going to cover is schemes and support, because there are schemes and there is support available where we can potentially help improve how to borrow, and it's certainly going to be a factor to consider, especially if you want to get the most out of your purchase. And spoiler alert, one of these I use and it really helped. Now, the first one I wanted to look at is shared ownership. Now, I don't want to spend loads and loads of time at looking at the individual statistics on shared ownership or looking at potential costs for rent and the other bits like that. But put simply, shared ownership is something that is really, really important for someone to buy their first home. If you cannot afford the home you want to live in for the long term, the start. Now, you can essentially buy a set percentage of the property. It depends on which developer you're looking at, and depending on what schemes they're willing to offer, depends on what amount you can purchase straight away. But most often time, 10% is like a good starting point for a lot of providers, 15% for others, 20% for others, where you can buy 10, 15, 20% of the share of the whole of a property and then pay the rent on the percentage that you don't own. And that's about as much detail as I want to get in for this video. And again, I'll make sure that I make a separate video about it. And if you want to discuss shared ownership in more detail, we certainly can. Now, likewise, this one one here, First Home Scheme, is a video that probably deserves its own video completely explaining the ins and outs of it, but it's a relatively similar scheme to the shared ownership with some fundamental differences that we can highlight. Now, the First Home Scheme is essentially where you can get a discount on a property anywhere from 30 to 50% of the total value. Now, the difference of this is that you do not pay the rent on the don't own. And you're probably thinking, wow, that's fantastic. Why don't I just do that? Because that sounds so easy. Well, the drawback to First Home Scheme, yes, you can buy the property there. You can probably see yourself for the longer term. The main drawback is you have to meet eligibility criteria, which means your income has to be under a certain threshold rather than above a certain threshold. But again, affordability still applies for the amount that you're purchasing. And then the other big drawback is that you can only sell the property to other people that qualify to that scheme. So what that actually means is when you go to sell the property, you are essentially limiting yourself to only people that are eligible for the First Home Scheme at that given moment, but also you're having to sell it for the same discount that was applied when you bought the property. So no, you're not magically being gifted equity. You're essentially giving that equity to someone else who then benefits from that discount as well. And they have to follow the same criteria and again, sell the property within that scheme in the future. So what this means is it's likely going to be harder for you to sell the home in the future, and you don't get any financial benefit from the original discount because you have to sell it for the same discount applied. Again, it's not for everybody, but 10,000 people every single year, or at least 10,000 households every single year, do benefit from this scheme. So it's something that we can't ignore, and it is there and it is beneficial. However, of course, if you can buy your own property in full or utilize the shared ownership scheme where you can staircase your way up, that is going to be substantially more beneficial to you than this scheme right here, and it's going to be far less limiting later down the line. Now, I mentioned that I benefited from one of these schemes, and it's this one right here, the lifetime ISA woman there. So the lifetime ISA is something that was incredibly important, not only for myself, but for my partner and for many of my clients. Now, I could talk for hours about how great the lifetime ISA is and how much it's benefited so many first-time buyers in this country, way more than 10,000 households a year. I'm absolutely certain of it. Essentially, you can get a £1,000 bonus every single year, April to April, when you put up to a maximum of £4,000 in the account. So it's a 25% bonus on whatever you put in. So if you're only able to put £1,000 in that fiscal year, then you're going to get £250 of bonus plus whatever interest rate the specific bank is that you use on the savings rate. Now, you can either use that towards your first home or towards retirement. And the only criteria is that you must be between the age of 18 to 39 when you open up the account. And two really big things that people don't consider, and they really need to consider: the account needs to be open for at least 12 months prior to buying your first home, which is really important because I have had a few people that are looking to buy their home and they say, well, why don't I just put my 4,000 in now? It's, well, actually, you have to wait 12 months. So don't do that. And then the other big one, which kind of falls into the same category, whereby you really need to remember this, is that taking money out of it triggers a 25% penalty, not the exact amount of bonus you've got, but a 25% penalty. So you can appreciate if you've got £100 in an account and they put £25 in for it into the account for you, you're going to have £125. Now, if someone took 25% of £125, that would leave you with £93.75. Yes, I did use a calculator because I didn't want to get into the pennies, and yes, I probably could have done it in my head, but I bothered. So yeah, you're left with less than the original amount. And of course, if you use the full 4,000 or 8,000 or 12,000 across many fiscal years, using that money that's not going towards either your first home or towards retirement is going to be an even larger penalty, something that I would highly recommend you not doing. Now, for me, to finish off the video, calculating your budget is super important, and it's something that I think is so valuable, and we have discussed it across this whole video. And establishing a budget really is going to enable you to truly understand how much you can borrow, because where we are in the current climate, I think 5.5-6 times your income with a lot of first-time buyer mortgage providers does actually then turn the question back to you. How much can you afford? Now, our job of calculating your budget is super important, and we actually have kind of mentioned it a few times throughout the video now, which is we need to calculate your budget by taking net income and reducing that by the amount committed expenditure. Now, for you guys, we do have to go off and potentially work out future costs, because these are things that you're going to be paying when you actually own your property. Now, food and subscriptions, I've left as a question mark, and that's something that you're going to go off and work out yourself, because let's be honest, I have no idea how much you spend on food. You might not even know how much you spend on food, and it's something that you might want to dig through your bank statements a little bit and do a little bit of research into your spending habits and actually work out how much you're spending on food. If I could hazard a guess, as a household, I probably spend in excess of 100 to 150 a week, just because we do go a little bit crazy on things like protein and other bits like that that are just genuinely more expensive. But I've seen households where it's genuinely pounds a week because of the way they manage things, the way they bulk buy things, and the way they live their life. They just plan very effectively, essentially. But that's the lowest I've seen. You might fall somewhere in between, you might fall above it, I don't know. And again, likewise for subscriptions, I don't know how many things you're subscribed to. You could have every membership under the sun, and that number is going to be significantly higher than mine. So again, we leave that up to you to go and work out. Now, Wi-Fi and phone, I have put numbers in there because we can base it off sort of average costs. Roughly speaking, a good Wi-Fi package is £30. If you want the full gigabyte or 500 megabytes per second, then obviously you're looking at nearer to £50 for Wi-Fi. If you've got a older phone like myself, then you're only paying the SIM card, which is £10 to £15 a month. But if you've got one of the newer iPhones, again, you're going to be nearer to that £50 a month, which is probably more realistic. And again, if there's two of you with new iPhones, you're going to be around the £100 mark. Again, you can amend this to match your own circumstances. Now, the new entrant into the list is the council tax, £180. Now, again, we're going like slap bang in the middle, council tax C, council tax D, in and around the £180 a month. Again, if you are in an area where the council tax is a little bit lower, you might fall a bit below that £180. If the council tax is higher, then again, we're talking maybe up to 200, 210, 220, depending on what council tax band you are and what parishment you fall under. But because there's so many bands and so many parishments and thousands of possibilities there, we're just going to have to go in the middle, which is around 100. You can actually check, and I'll leave a link in the description. I need to remember to link quite a few things in the description, which is how to check your future home's council tax. Now, apparently water bill on average is £61 for a two-person household per month. Now, I'm going to be completely honest with you, that is taken off of the Money Saver website, which I will link again, the link to this exact page where it's updated. My personal bill was £30 a month. So, and that's for two of us in a 3-bedroom house. So again, that number could be slightly higher, could be slightly lower. I would actually say that in most scenarios, it's slightly lower, unless you are actively using a very, very high amount of water. And to be honest with you, we aren't very frugal in usage anyway. So again, that is in and around where it's going to be, around the £50 to £61, which is apparently the national average for a two-person household. Now, gas is next on the list, apparently a £73 average for a 3-bedroom house in the UK. Again, if you're buying a property that's slightly bigger, or buying a property that's slightly smaller, then that number is going to be slightly different. And again, it's not going to be taken for gospel. This is just the average figures based on a bedroom, which is the average size per K. So again, you're going to get a pretty good idea there. Cost. And finally, your electric bill. On average, 3-bedrooms houses in the UK with a electric charge of £80 per. So that there leaves us with £474 in total, based on averages. Again, your phone bill might be higher, your Wi-Fi might be higher. And again, that is not including food and subscriptions, which you'll have to go and work out for yourself, because again, we can't really go off the national averages for those because it's so personalized. And again, the figures are going to be very skewed. Now, for the sake of the video, I'm going to put in my average, which is around £400 a month for food for the two of us, and probably in around £100 worth of subscriptions. Yes, that includes TV licenses, Netflix, Disney Plus, and then a couple of other bits on top of that as well. And again, yours might be higher, might be lower. It's definitely worth working out. So what that's going to give you in total is an estimate figure, when you throw in your accurate Wi-Fi, phone, food, and subscriptions in, of what your expenditure is going to be outside of the mortgage. So total your net income as a household, and then minus off your total expenditure there, and you're going to be left with a pretty good idea of what your budget should be. Now, again, I wouldn't recommend using that total figure towards your budget, but definitely a good proportion of that should be dedicated to payments, just to make sure you are reducing that term to it. So just to really hone that in there, we are taking household net income minus household expenses. And that's going to give us a really, really good idea of what your monthly budget should look like. So for those of you that are now thinking, well, what's the next steps? How much can I afford to borrow on a mortgage? Now, it's relatively simple for most of you, as per the first slide. We need to times your income by 5.5 or 6 times. Do we need times it by 5.5? Does that give you the amount of mortgage that you need to buy a property you are looking for in your area, the right size, and somewhere you can see yourself for 10 years? If the answer is yes, fantastic. If it's not, you stretch that to 6 times, put that into a calculator, see what it comes out with, and you should have to have. Then your second job is to then go in there and calculate your expenses based on the property you're looking to purchase. taking your net income. Now remember, the 5.5 or 6 times your income is using your gross income. When you're calculating your actual costs and expenses and what you can afford to actually pay, you want to take your net amount, because that's the amount that's going to be coming into your bank account every single as a household. Now what you want to do is go off and put that total mortgage amount into a mortgage calculator, or allow a mortgage advisor to go off and do that for you. And then what you're going to be able to do is see the cost. Now, if that total cost is higher, yes, higher than the budget that you managed to work out for what you're comfortable paying on a monthly basis, because it's so important that you are comfortable paying it on a monthly basis, because I'm not going to be the one paying it, you will be the one paying it. So if you're comfortable with the amount, the total amount you want to borrow is going to cost, and it falls within the income multiple looked at, then fantastic, you're in a great spot. That's how much you can borrow. Have a conversation with an advisor, get a mortgage in principle. Now, if you use that figure and you're thinking, actually, that is too expensive, I cannot afford to do that, and you've had a conversation with the mortgage advisor around the different flexible options that are available, then obviously tone it down. Decrease the borrowing amount in line with what your budget is until you find that perfect balance using today's interest rates, ideally. And then that's going to give you a really good idea of how much you can actually afford to borrow, not from what the lender's saying, but actually from what you've gone off and worked out. And if you've done all of those different things, you have put yourself in the absolute top bracket of people that have prepared themselves for moving home. You have put yourself in such an advantageous position, not only for today, but for the next 10, 15, 20, 30 years, whatever your mortgage term is, potentially all the way up to 40 years. Your preparation today, whether you're using the bonuses, whether you've set your own budget, are things that are going to benefit you for the rest of your life. And remember, you don't have to make this decision yourself. This is why people like myself have taken exams to make sure that we can best prepare you for this massive decision, which is going in and buying your first home or moving home or any of these different things. They're massive decisions, and that's why we're regulated in such a way that benefits you not only today but for your life as well. So if you need any help, obviously reach out to the necessary people and make sure that that is set up. Now here is the completed document, and again, apologies for any of the creativeness here. I'm not the most creative person, but it's all there available. All the information we've discussed, you can screenshot it, you can highlight it, you can go back through the video, going through certain timestamps as and when they pop up, and obviously listen to any and all for planning purposes. Now finally, I'm going to recommend a video for you to go off and watch on my channel. This is the video that I believe is going to be best suited to you, your circumstances, and obviously planning for next steps in your home buying journey. So click on the video on your screen right now, enjoy it, and hopefully we'll be there every step of your home buying journey. Good luck, and I'll see you very soon. Bye-bye.